Hey, hello friends. Welcome back to my channel 30CAGR. In this video, we are going to discuss about an important concept called drawdown. This is the term that many traders and investors hate. This is the concept that destroys many successful trading strategies. And this is the concept that bleeds our portfolio if not taken care properly. This is just like health sickness. We all have to experience sickness at one or the other time in our life, right? We can't completely avoid that. But there are certain best practices through which you can avoid sickness to some extent. Like we can do exercises or lead a stress free life so that we can bring down sickness to some extent. Likewise, we cannot completely avoid drawdowns in our trading journey. However, if we follow certain best practices, we can surely bring them down to some extent. In this video, we are going to see what are those ways through which we can reduce drawdowns to certain extent. And if you're wondering where this drawdown falls in the entire spectrum of stock market, this falls under risk management. As I always say, trade psychology and risk management are the two most important concepts of stock market, and this falls right under risk management. With that background, let's dive in. My name is Raj, and 30cagr.com is my blog. This is the blog where I put all my trading strategies that can help you to actually make money in stock markets. And I also provide some free trading bots and other stock market tools. So please feel free to visit my blog and avail all those for free of cost. And last but not the least, if you haven't subscribed to my channel, please subscribe it immediately and hit on bell icon because this is the only way to instantly receive all my future strategies of stock market. All right. So here's the agenda for this short video. First, we will see what is a drawdown and what's the difference between drawdown and max drawdown. And then we move to an interesting topic. What if we don't consider drawdowns? Or why is it very important for us to consider these drawdowns? And then last but not the least, we will see how we can reduce these drawdowns. I divided this into two sections. One is at a strategy level, and then the second and the most important is at a portfolio level. If you want to continue your journey in stock markets for a long time, you need to reduce your portfolio level drawdown very importantly. So we will see how to reduce both strategy level and portfolio level drawdowns. All right, the definition of drawdown is very simple. It's the reduction in capital from peak to trough. I have a small pictorial representation here to make the definition easier. So let me first explain in an easier way for beginners, and then I'll go into a little bit of details for advanced traders. So let's say we have started with 1 lakh capital and this entire period is for 1 year. Now for beginners, the simplest way to think about max drawdown is ignoring the last part. The peak of this entire period is 1,25,000, right? And then the trough is 75,000. So this is the minimum amount that we have for this entire period. The reason why I asked you to exclude this last amount 1,35,000 is after this there is no trough. That's the reason we don't consider this. Now we have a peak of 1,25,000 and then a trough of 75,000. The way to calculate max drawdown is 1.25 lakh minus 75,000 divided by 1.25 lakh. This is the formula to calculate max drawdown. In fact, any drawdown. So in terms of percentage, this will be 40%. So if you are evaluating this strategy and the drawdown is 40%, it means that at any given stage, the maximum amount that you might lose is around 40%. And this could happen anytime. Let's say you started with 1 lakh and it can happen right after entering into this strategy as well. So your 1 lakh might become 60,000. That's what drawdown means. Now, if you have to go a little deeper into the concept, there is a difference between drawdown and max drawdown. Let me differentiate these two. We started with 1 lakh, right? And then we went to a capital of 1 lakh 10,000, which means we got a profit of 10,000 rupees. Now, this is the peak. And after this peak, our portfolio started coming down, our capital depreciated a little bit and it became 90,000. So at this point in time, if you have to calculate drawdown, it would be 1 lakh 10,000 minus 90,000, which is 20,000 divided by peak here is 1 lakh 10,000, just like we have done this calculation, right? But think about it. At this point in time, when we have this 90,000 rupees, we do not know whether markets go up or it can further go down also, right? If it has come down to let's say 85,000, then it will be 1 lakh 10,000 rupees minus 85,000 divided by 1 lakh 10,000 again. So what is important here is until you have a new peak, the drawdown cannot be concluded. Okay, since we have a new peak which is 1,25,000, we can say that for this entire wave or this entire cycle, the drawdown is 1,10,000 minus 90,000, which is 20,000 divided by 1.1 lakh, which is 18%. So for this first cycle or first wave, the drawdown is 18%. Now that we have a new peak, let's see what is the drawdown. As I said, after this new peak, our capital came down to 80,000. But at this point in time, if you want to calculate drawdown, it will be 1,25,000 minus 80,000, which is 45,000, 45,000 divided by 1.25 lakh, right? So you'll have some percentage. But wait, what I said was this is not the final drawdown until we have a new peak. And that's what exactly happened here. From 80,000, we went to 95,000. And then from 95,000, again, our portfolio came down to 75,000, right? So here the drawdown is 1,25,000 minus 75,000, again divided by our peak 1,25,000. So for this entire wave, our drawdown is 40% as we have already calculated. And since we have a new high which is 1,35,000, if we had next few trades and if the capital came down to anything below 1,35,000, then we'll have the calculation for the next drawdown. So this is how you need to individually calculate drawdowns whenever you have new highs. So here 1,10,000 is a new high, 1,25,000 is a new high, and 1,35,000 is a new high. Every time you have a new high, a new drawdown will be calculated. And the difference between drawdown and max drawdown is in the first cycle, we have 18% drawdown. And once we have the new high, in the second cycle, we have 40% drawdown. And let's say in the third cycle, we again have 25% drawdown. Now, the maximum of all this is called maximum drawdown, which in this case is this 40%. Now, a couple of important points that we need to remember. First is drawdowns are different from losses or consecutive losses. In fact, I hear this from many people, and in many videos also I have seen people saying that drawdowns are nothing but consecutive losses. No, that is wrong. Let's say you started with 1 lakh and in every trade you are losing 5,000. And let's say you have four consecutive losses. All right, this is not loss, this is lakh. Now, in four consecutive losses, you lost 5,000 in each trade, which becomes 20K, right? So your capital becomes 1 lakh minus 20, 80,000. Now, let's say you have a profitable trade. Again, you got 5,000 rupees and that made your capital as 85,000. Now, again, you have three consecutive losses, which means you lost 15,000 altogether. And then your final capital became 70K. Now, if you think about it, your maximum drawdown here is 1 lakh minus 70,000 divided by 1 lakh, which is 30%. However, if you look at the consecutive losses, maximum consecutive losses are 4 here, and then you have 20,000 loss, which is 20%. This point is very important. So please make sure that you understand that maximum drawdown is not equal to consecutive losses. So this is the first point. And then the second point is whenever you are looking at maximum drawdown for any strategy, you need to think about the back testing horizon. The reason why it is very important is Some people say that their strategies have very less drawdown of, let's say, 5% or 10%. But we need to ask, what is a time horizon? What's a time period? Is it just for 1 month or 3 months or 1 year? If it is for lesser time period, obviously there is a chance that the drawdowns are very less. However, when you increase your backtesting period from 1 year to, let's say, 4 years or 5 years, that's when you get to know the credibility of the strategy. Because in the last 4 years or 5 years, if you still have same drawdowns of 5% or 10 years, that's when you can actually rely on that strategy. Because even if you increase, even if you look back for the last 4 years time period, there was never an instance where your losses were more than 10%, right? However, if you take lesser time periods of 1 month, 3 months, or 1 year, there could be a chance that it was not more than 10%, but you never know. If you go back to 2 years or 3 years in time, then maybe this 10% would have become 30% or even 40% also, right? Because you are not looking at the full picture, you are only looking at last 1 year picture. So my point here is, whenever you are looking at any strategy, make sure that you have a good sample of trades. Don't do it for 1 month, 3 months, or 1 year and come to conclusion. Do it for a good sample size, and that's when you get to know the true picture of this drawdown, or for that matter, overall profits. And then the next is, why should I care about drawdowns, or why is it so very important? It is important because the percentage of capital lost is never equal to percentage of gains to recover. What do I mean by that? If you lost 50% of your capital and then you gained again 50% in your portfolio, it's never the same. You will never be able to get back all your lost money. That's because the time, effort, and energy that you need to spend to recover your lost capital is more. You need to pour in more blood and sweat to recover all your lost money. I've put a small table to give you an example. If you lose 5% of your capital, you need to gain 5.3% to recover all your lost money. Likewise, if you lose 10%, you need to gain 11.1%. If you lose 25%, you need to get 33.3% return to get back all your lost money. And finally, let's say you lost 50% capital, then you need to get back 100% returns. Let me give you a small example to explain this better. Let's say you have 1 lakh capital in your portfolio, and because of some series of bad trades, your capital went down to 50,000, which means you lost 50% of your portfolio, right? Now, let's say in the next 1 or 2 months, you are lucky and you have a series of good trades, and again you recovered 50%. But now 50% of 50,000 is what? 25,000, right? So with the original capital 50,000 and the profits that you earn 25,000, it becomes 75,000. But your original capital is 1 lakh. So if you lose 50% first and then you gain 50% later, it is never equal to the original capital that you lost. Both these two are never equal. You will still end up with a deficit of 25,000. So for you to make this 50,000 rupees to again 1 lakh rupee, then you need to earn 100% return. So while losing, you are losing 50%, but while gaining, you have to earn 100%. The point here is, if we allow drawdowns to take away our profits, then we need to put in more energy, time, and effort to get back all the capital that we have lost. So ensure that your drawdowns are always within the limits. Okay, now that we have seen what exactly is this max drawdown and why we should consider this for our trading purposes, in part 2, I'll explain you some of the ways to reduce this drawdown both at a strategy level and at an overall portfolio level. I'll put the link for part 2 in description. Please go ahead and watch that part as well. Alright, so before I end this video, I would like to tell you that if you want to open a trading account using my referral ID, I'll put links in my description. You can open in Upstox, Zerodha, LS Blue, or Angel Broking. One advantage of opening trading account using my referral ID is just like you get a key to a house full of possibilities to earn money in stock market. You get access to free trading bots, you get access to all PDR stocks that I invest in, and there are ton of features that I'm going to release in future. And traders who open using this referral ID will have access to all these features absolutely for free of cost. So you can check description below to have links to all these broken forms. And if you haven't watched ISS and PDR strategies, I highly encourage you to go ahead and watch those two strategies. Those are the strategies that actually give you money in stock market without putting much efforts. You can go to my blog or visit YouTube homepage to get the links of these strategies. And lastly, if you haven't subscribed to this channel, subscribe and hit on bell icon to receive more such interesting videos. Thank you and see you in the next video.